Good morning. Thank you for joining us for this presentation of Idox PLC full year results for the year ended 31st of October 2022. On our agenda today, I'm just going to take you through a few highlights of our FY22 year. I'll then hand over to Anoop, who's going to take you through our financial review. And then I'll come on to cover off our strategy and operations review, talk a little bit about our buy and build strategy, cover off our ESG initiatives and give you a view to outlook. And then we'll take any questions that you may have. So without further ado, we'll move into our operational highlights for last year. Already now it seems a little bit distant as we've entered the new financial year. Financial year 22 for Idox was a really strong year where we delivered good results against a very challenging economic and geopolitical situation and backdrop. And we're really pleased with the level of performance that we're able to deliver. So we had a record full year order intake, up 19% to 74 million on the previous year, where we did 62 million. And the reason we're pleased about that, obviously, is it gives us good visibility as we go into financial year 23 and our ability to deliver against numbers that we're projecting for this year. We had a significant number of contract wins and extensions, which increased our average tenure across both our public sector and EIM businesses. And again, really pleased with that. Great renewals from clients, some great new business wins, which we'll talk to a little bit later in the presentation. And again, a really solid foundation for us to move forward from. We're also really pleased to enhance our geospatial capabilities with the addition of the Landhawk acquisition at the back end of the year. And again, we'll talk a little bit more about how we see geospatial moving forward. And good growth of revenues and profits in our public sector software business, buoyed by our FY21 acquisitions, and a really solid performance in EIM, despite what we could see was some very difficult and challenging market conditions. We've continued to upscale our operations in Pune in India, building out there our software development capabilities, but also building a centre of excellence to increase our efficiency capabilities and knowledge sharing. And within the business, continued investments in our people and our products, and a clear focus on innovation and consolidating our product portfolio and moving more of our clients to the cloud across the whole of our client base. So a really strong year for the business, as I say, in very challenging circumstances. We're pleased to deliver very reliably against that backdrop. And to just give you a bit more detail on that, I'm now going to hand over to Anoop, who's going to talk you through some of the financial review.
Thanks, Dave, and good morning, everybody. Welcome to our full year results. Now let me take you through the full year results for the group as a whole, and then I'll move to the individual segments in more detail, pulling out some key themes and observations for the year. So overall, the group delivered a resilient performance in challenging market conditions, and it's pleasing that our results were in line with our expectations. We delivered revenues of £66.2 million, which was 6% up on last year and demonstrates the continued progress the group is making. Since 2020, the group has delivered an average revenue growth of 7.5% per annum, and as it continues to advance its strategy and focus as a pure software business. Of the £66.2 million, £40.5 million was generated from recurring revenue, which is up 12% on the prior year, from £36.3 million, as we continue to win longer-term contracts with our customers. Recurring revenues now account for 61% of the group's overall revenue, compared to 58% in the prior year, and have been assisted by the group's acquisitions in FY21, along with good growth in local government and cloud. The group ended the year with a record order intake of £74 million, which is up 19% on 2021 at £62 million, and provides good visibility going into FY23. And pleasingly, given the wider macro environment, our adjusted EBITDA is up 15% at £22.5 million. This has been driven by a combination of our M&A strategy, strong customer relationships, price and mix changes, and a disciplined approach to cost management despite the external inflationary pressures. The positive contribution on EBITDA has flown down to earnings per share, where we delivered an adjusted EPS for the period of 2.44 pence per share, up 7% on 2021. We continue to focus on cash generation and strong cash management. And as a result, we have reduced our net debt by 18% to £6.7 million from £8.1 million in the previous year. This compares to a net debt position of over £30 million back in 2018 and demonstrates the significant progress the company has made over the past few years in managing its debt levels and cash generation over this period. Coupled with an RCF facility of £35 million, this means that the group has a good balance sheet strength and resources to pursue its accretive M&A strategy. Given our continued progress, the group has increased its dividend by 25% to a proposed dividend of 0.5 pence per share. Going forward, the group will continue to monitor its dividend policy and its appropriateness in the context of the group's overall capital structure. Now, moving on to the breakout of the results in a bit more detail, starting with our public sector software business, PSS. So as a reminder, our public sector software business includes the majority of our product offerings and comprises our built environment products, which incorporate local authority planning, building control, and public protection products, including our cloud solution. It also includes the results of our FY21 acquisitions, Aligned Assets, Exegesis, and Thinkware, and products in relation to transport, elections, health, and grants. We delivered revenues of £58.3 million, which grew 8% on the prior year. The 2021 acquisitions delivered a full 12 months revenue to the results. When combined, these three acquisitions delivered £5.9 million of revenue in the year. Excluding the impact of the acquisitions in both 2021 and 2022, like-for-like sales remained stable, where increases in local government, cloud, elections, and databases were offset by reductions in our transport business. Of the £58.3 million of PSS revenue, £34.6 million was generated from recurring revenue, representing 60% of the total revenue, and which was up 15% on 2021. Our order intake for the year was £65 million, up 22% on the prior year. We continue to lead the way in the provision of digital SaaS platforms for our customers through our cloud solutions, winning 15 new customers to the platform in the year. New customers included North Warwickshire Borough and Rother District Councils. Our cloud conversion strategy saw continued successes in the year, with more customers committing to longer-term agreements, including both Shropshire County Council and the London Borough of Brent. We also saw significant successes in our uniform customer base, particularly in the provision of cloud services, where successes included Aberdeenshire, North Lanarkshire, Sunderland City, and Newport City Councils. In Aligned Assets, we continue to win new business throughout 2022, with notable success, including the provision of an address management system to the Metropolitan Police. In social care, we saw new wins in Oldham, the Isle of Wight, and Cambridgeshire. In our sexual health solutions, there were new wins with a number of NHS trusts and Virgin Care services. In elections, we won new contracts both in our elections management software and our print and managed services, which included Oxford City Council, Somerset Council, and the Scottish Borders Council. Our databases business continued to attract additional customers, where we secured over 100 new customers to our Grant Finder and Research Connect SaaS solutions. Non-recurring revenues remained broadly flat at £23.7 million, where increases in elections, Exegesis, and Thinkware were offset by reductions in transport and local government. We ended the period with an order book for the services element of our business at £9.1 million, which was up from the £8.5 million in 2021, reflecting an element of the wins I just talked about. Adjusted EBITDA was up 17% to £21 million. Whilst we continue to invest in our cost base, for example, investments in a developments team and investments in India, we remain disciplined and controlled in the way that we're approaching this. That, coupled with increases in revenues and changes in mix, has resulted in an improved adjusted EBIT margin percentage of 36%. Now, moving on to EIM. As anticipated, and despite the challenging market conditions, we saw an improved performance in EIM during the second half of the year. For the year as a whole, revenues remained stable at £7.9 million. Similarly, both recurring and non-recurring revenue remained stable at £6 million and £1.9 million respectively. We secured 15 new customers across a number of different industries. This included new contracts with Loomis Technology, TransAlta Energy Corporation, and Adani Ambuja Cements. We also saw continued commitment and large projects from existing customers, including Canadian National Resource Limited, Oxy Inc., Public Service Enterprise Group. As a result, the services element of our order book was up £0.4 million at £1.4 million at the end of the year, and our overall order intake for the year was £9.3 million. And finally on this slide, the adjusted EBITDA and margins remained stable at £1.5 million and 19.4% respectively for the year. Leading on to the more detailed income statement. Having commented on the divisions already, the other areas I'd briefly touch on include the depreciation and amortization charge of £6.9 million, which excludes the amortization of intangibles and was up £0.3 million on 2021. The group reported an adjusted EBITDA of £15.6 million, up 21% on 2021. There was a higher interest charge at £2 million, largely driven by the non-cash swing in foreign exchange gains on the euro-denominated bond in 2021, moving into a foreign exchange loss position as sterling weakened against the euro. Our adjusted effective tax rate is in line with prior periods and is at circa 19%, in line with the statutory tax rate. As a result of these adjusted items, the adjusted profit after tax for the year was £11.1 million, up 8% on 2021. Now, in respect of the adjusting items, the key movements in the year related to restructuring costs in relation to corporate simplification activities and an increase in the share options charge. This has increased to £2.6 million based on share-based payment accounting rules for new and past awards. Taking into account these items, the group reported a statutory profit after tax of £5.6 million. We reported a loss of £0.6 million on discontinued operations relating to the finalisation of accounting in connection with the disposal of the content business in 2021, which are now complete. As a result, the group's total statutory profit after tax was £5.0 million for the year. Whilst this was lower than the reported profit last year in 2021 did include £6 million of disposal gains in relation to the content business. So moving on to the group's cash flow for the period. So the group generated net cash from operating activities before tax of £18.3 million. Against the group's adjusted EBITDA of £22.5 million, this equated to a conversion rate of 81%. The reduction in the conversion rate is primarily driven due to the final settlement of VAT deferrals from 2020, exceptional cash costs in the year, and the phasing of certain creditors and debtors. The group became a net taxpayer in the period of £2.6 million of outflows. The 2022 tax payments were higher due to the timing of 2021 payments and tax payments in connection with the 2021 acquisitions. Acquisition and disposal cash outflows of £2.1 million related to deferred payments in connection with the 2021 acquisitions and £1 million in connection with the acquisition of Landhawk in October 2022. In total, the group invested £7.6 million in capital expenditure. Of this amount, £6.6 million was invested on software development. Now, we have a number of platforms, all of which are at different stages at the life cycles. These platforms all need continued investment to remain current and operational. For example, this may include regulatory updates, technical refreshes, systems consolidation, functionality and speed enhancements, and further investment in our cloud solutions. The group paid a 2021 dividend of 0.4 pence per share, which resulted in total cash outflow of £1.8 million. After interest, lease payments, and other items of £2 million, the group improved its net debt position by 18% in the year to £6.7 million. Moving on to the balance sheet. Overall, the balance sheet has remained stable year on year. The key movements I would pull out are that fixed assets have remained stable in a period where £9 million of additions in acquisitions-related intangibles, software development, and tangible assets have been offset by a similar level of amortization. Trade and other receivables have reduced slightly following the finalisation of accounting in respect to the content business, and trade and payables have reduced predominantly due to the payment of deferred consideration of VAT balances. And the reduction in provisions is largely driven by the finalisation of legacy property matters, which are now closed. Our net deferred income balance is stable at £14.5 million and is reflective of the nature and timing of our billing profiles in the April-May period. And finally, at the bottom, I highlight the constituent parts of our net debt balance of £6.7 million, which includes €30 million denominated Maltese bond, which matures in June 2025 at a coupon of 5.1%. And finally, moving on to our guidance for future years. This is consistent with guidance communicated previously, reflecting the medium-term outlook for the business. So from an organic point of view, we continue to believe that mid-single-digit growth is sustainable over the medium term in both PSS and EIM. From an EBITDA margin point of view, we very much expect to continue the journey to deliver 35% adjusted margin on a sustained basis through a mix of efficiencies and the acquisition of higher margin businesses. In terms of cash generation, I continue to expect the business to generate good levels of cash against EBITDA, and over the medium term, I'd expect cash conversion rates to be closer to 100% of EBITDA. In respect to our dividend policy, the board has proposed a dividend of 0.5 pence per share, up 25% on 2021. We will continue to keep the level of future dividends under review in consideration of our financial position and delivery of our strategy. However, I would expect the dividend to progress as we continue to grow the business. And just finally, in terms of 2023, we've started 2023 with a strong recurring revenue, good levels of contract renewals, and a solid order book, along with a healthy pipeline. We've made an encouraging start to the year, and as a result, we're well placed in our aim to grow the business by double digits. Therefore, our expectations for FY23 remain unchanged, albeit we do remain cognizant of the current economic environment. At this point, I'll hand back to Dave, who will take you through the rest of the presentation.
Great. Thanks, Anoop. So I thought we'd just spend a little bit of time looking at strategy and operations. All of the people on this call will be very familiar with our walk, run, fly strategy and also with our 4 pillars. But I think what's clear is that, the strength of the financial performance that Anoop has outlined, doesn't just happen. It requires us to have a clear strategy. It requires us to be very clear about what drives our economic engine in the business. It requires us to have a very clear focus on how we can drive forward our market positions, and also to be very, very focused on areas where we can excel. And that continues to be the drive and the thrust here at Idox. We became a pure software business with the disposal of our content operations, and we will continue to drive our software excellence and look for repeatability in our solutions in the markets that we choose to address. That creates healthy margins in the business and a very strong future client base that we can continue to service well with new products and services that we develop. So with that in mind and delivering success, our strategy remains intact. We've made good progress in the first elements of our fly phase. We would hope, as Anoop has pointed out, to continue our focus on growth, and this year look to double-digit growth across our operations, which will, I think, give us added impetus in the business, improve levels of cash flow in the business as well, and give us more ammunition to develop our accretive buy and build policy. And with that in mind, we have developed our organizational model accordingly. So on the next slide, we can see that whilst we remain very clearly sighted on repeatable software solutions, we've also put together an organizational structure which is focused to growth. And we have promoted 4 individuals in the company into senior leadership positions, which are highlighted in these 3 divisions here. Our land, property and public protection business includes all our regulatory services, built environment, public protection, and our geospatial businesses. We have our community solutions, which focus on sexual health management, funding and information services, and elections. And we've put our assets business together, which includes our EIM business, supplemented with our CAFM, IFIT, and transport business. Scott Goodwin, Chris Evans have taken on responsibility for our land and property and communities area, and Steve Bruce has stepped into the role of leading up our assets business. All of those people are internal promotions here at Idox, and all have been through our Leading Together program, which we're very, very pleased about. And seeing graduates of that program step into leadership positions, I think gives us a lot of confidence about the future for the business as we grow both organically and inorganically. In addition to that, Rick Hazard, who joined us as head of software development when we bought Tascomi back in 2019, has been promoted to head of engineering across the entirety of our business, bringing cohesion in product design, tools, and the way that we go about our future product developments and reusability. And we're very, very excited about Rick's appointment. I think that's, again, indicative of the talent we have in the business and the opportunities that it has for growth as we go forward. So with that in mind, I thought I'd just give you a quick update on our M&A capabilities and our progress there. As you know, we made 3 acquisitions in FY21. we've invested significantly in the integration of those businesses with the Idox core, and that's now complete. And we're very pleased with all of the businesses that we've acquired to date. We think they add greatly to our product capability and capacity with clients. We've invested significantly in our M&A program in early FY22 with the appointment of Rob Grubb as our Director of M&A. And we've had a number of extensive discussions with potential targets during the course of FY22, which obviously came through to the acquisition of Landhawk late on in the year. But we have talked in process to about 40 businesses, advancing to valuation analysis for about half of those as we went through the year. And currently, our pipeline of opportunities for M&A is a strong one. And we are focused on moving forward with some of those targets as we go forward into FY23. So pipeline looks good, and our focus really at this moment in time is in continuing to develop out our land and property public protection area, and also looking at opportunities where we can bulk up our communities business where it's appropriate to do so. So we're very interested in technologies and products that might help bolster our healthcare operations, for example, which we think would just give us more market presence and an ability in future to improve margin delivery in that part of the business. So just moving on one slide, as you know, of the 5 acquisitions we've made in recent years, we now consider that we have some of the best geospatial capabilities and products in the UK, which we see as essential to the UK land and property infrastructure moving forward. The story so far is that our solutions are primarily in local government and in blue light services. Anoop mentioned earlier that during the year we were able to secure a significant contract with the Met Police for address management. On top of that, we also have embryonic commercial offerings that we're quite excited about. Geospatial data has good levels of support and funding from central government and from our clients elsewhere to drive forward improvements, and are also primarily being seen to good effect in a burgeoning commercial prop tech sector. So as we go into the future, our idea and strategy is to leverage our geospatial credentials, build on our existing local authority and commercial work, and create software and data solutions which connect the ecosystem that we see. So as well as local authorities needing great geospatial data, we also see construction companies, property entities, land management businesses increasingly requiring sophisticated applications that connect them with their supply chain and with their production chain, and also smart data solutions that we think we can monetize that would help them become more efficient and more effective. So as we go forward with our acquisition strategy, our activity in respect to geospatial remains high, and we look to build out on the acquisitions we've made to date. So what I'd like to do now is just move on to a few other areas of the business and the progress that we've made, particularly around ESG. Idox has committed to achieving a net zero target on emissions by 2040. We're currently working well in advance of that target. Underpinning all of our environmental protection and impact reductions initiative is our environmental management system, which is accredited as you would expect. And whilst our emissions have increased during 2022 compared with 21, as the impact of travel and other pandemic-related restrictions have eased, we do remain significantly ahead of our plan to achieve net zero by 2040. That plan required us to reduce from our base target in 19 at 5% per year. And as you can see, we remain well ahead of that. And we have a number of programs and initiatives underway to further reduce our carbon footprint on the back of our success to date as we go forward into 23 and beyond. In 23, we introduced an electronic vehicle scheme for all UK employees. And as we go into 23, we'll further look to reduce our baseline of office footprint as we consolidate our office locations that we've made through acquisitions during that time. But of course, our people always inspire our journey here at Idox. We're very centered on ensuring that our employees who are delivering all the outcomes for shareholders buy into Idox as an employer of choice. We want our people here at Idox to be their very best self at work. And during the course of the year, we launched our Dare to Be Different survey just to understand more about our work colleagues and understand what initiatives they would like to see that will help drive their ability to deliver their very best work here at Idox. So that survey was really helpful. We found we had 15 different ethnicities within Idox in our workforce. 13% of our colleagues were from the LGBTQIA plus community, 13% of our colleagues being neurodivergent, and 16 different religious beliefs here at Idox. And all of those things, I think, add to the quality of our workforce and also bring forward some of the things that will help them feel comfortable and able to do their best work in the business. We also focus really heavily on our community engagement and our employee engagement activities. And during the course of the year, we've tried to encourage all of our teams not just to come together to work more coherently outside of our day-to-day operating activities, but also be part of the communities that they serve. And as you can see, there's a nice picture on this lovely slide that talks about our individuals from the business taking part in helping out at Murdoch Park in Glasgow, our finance team getting together to do stuff outside of their normal work activity. And we find all of those things really help improve their connectivity with the business, but also our connectivity with each other. So we're very grateful for all the work that goes in from that part of our business. So if we look to outlook, as Anoop said, FY23 has started well and is in line with our expectations. We believe we're really well placed to deliver a strong year of performance. Our high levels of recurring income, contract renewals we've seen, the improvements in order book and pipeline give us great visibility and leave us well placed to grow the business by double digits in FY23. We continue to invest in our products and our services. We feel that's very important for long-term benefit of the company, and that includes obviously our work around geospatial. And our operational changes, we believe, have been really important and have come at the right time to make sure that we can underpin our financial performance with a clear focus on what our clients require in each part of our business areas. And as Anoop's pointed out, our strong balance sheet and facilities allow us to continue a selective and a very accretive approach to acquisitions. And we're excited about the opportunities that they bring in FY23. So as we look forward, we're really looking for a strong double-digit growth in our revenues this year and an improvement to that growth added to by acquisitions that we would make during the course of FY23. So with that in mind, if I can hand back to Tamsin, and we'd be really happy to take any questions that you might have.
Thank you very much. And we've got a question from Julian Yates at Investec.
I had a couple of questions, if that's okay. The first one is the transition to cloud across the business, and your comments on contrasting with your comments on the level of R&D going to the business, managing a number of product portfolios, all at different stages of their maturity, and that requiring continual investment. How should we think about that transition of those products at a very top level and the migration to the cloud platform in the context of efficiencies, margins, scalability, in terms of where we are on that sort of journey from I guess, a top level point of view? And the second question is really aimed at the new divisional structure. Very interested in the background and the thought process behind moving to these sort of three divisions. And if we should expect, or if the business is looking at driving each one in a particular dynamic of growth or margin, are there different profiles there? Are there different objectives for those three divisions? How should we think about that in terms of those sort of distilling out to the overall strategic and financial objectives of the business?
Well, look, I'll definitely take the first one, and then Anoop and I will probably split the second one.
Okay.
So in terms of our journey to cloud, obviously the vast focus for us has been around our local government business and the work that we do in land, property and public protection. The Idox cloud offering has been extremely popular during the course of the last 12 months, and we see ourselves with a very healthy pipeline of new opportunities going forward. So of the 15 new wins we made in that area, we've probably had about a quarter of those, a quarter to a third, which have been from existing clients who are making the move from traditional Idox products into a cloud-based delivery. And then the remainder of those have been competitive new wins, where we're seeing other people's clients who want to make that journey into cloud choosing Idox as the way to do that, given its pedigree and its clear market leadership position. So we're thrilled about that. Obviously, we're going to continue to invest in those cloud products. It's very important that they continue to move forward, not just from a legislative point of view, but also move forward in helping people undertake their day-to-day functions in the smoothest and the easiest way that we can, all from the joy of that hosted environment. And as well as hosting, we're seeing an improvement where clients want to remain with the very functional solutions that they have. They're also under pressure in our local government base to provide the right skills at the right time to manage those solutions on a day-to-day basis. And that, as you know, in an environment where skills are very hard to come by, has proved increasingly challenging for them. So as part of that journey to cloud, a lot of clients are also asking us to host solutions that they currently have as on-premise solutions as well. So that's the journey there. In most of our other areas, we've already committed to moving to the cloud. So in CAFM, for example, our web and browser-based systems are available this year. That will help continued sales of that product into that particular area of the business. Our Fusion Live product is honed in the cloud and built in the cloud native product, and is seeing strong progress. And we'll continue to develop our application sets according to their ability to work in the market. I don't see our election system moving into a cloud-based activity. I think it's set up such that most of the election activity that happens in the UK will continue to be a sort of as it exists today, but we'll put some new functionality around the software to help digitize the way that work is conducted, particularly around the census and various other elements that go on around elections moving forward. But our main focus as we go on is the continued development of our cloud products, rather than having to start from scratch with cloud offerings. And it's really about the ability for clients to move into that new environment, as opposed to our ability to deliver that capability. So we're just working with clients, making sure that we're tuned into their journeys, making sure that when they are ready to move to the cloud, that we're absolutely have done all the pre-work and are ready for them to make that journey with us. In terms of the new structure, the background to that is very much around growth. It's that simple. Our first few years of operating the business has been to make sure that it runs correctly, that it runs efficiently and effectively, and that we carry the disciplines that create a good business. But we now have done all of those things, and our focus is on growth. Our focus is to make sure that we provide the right energy and gestalt to move these things forward. And so it's about providing that additional level of commitment to help the business grow and support those leaders in bringing their expertise to bear to help us on that journey. And so as we go through 23, we're expecting, we think all of our businesses have the ability to grow, and we're really looking forward to supporting those teams in making that work going forward.
Will you report the those divisions on a separate basis going forward, or should we sort of expect the current one to continue? How will that be managed going forward?
Yes, so Julie, my intention is at the half year to report under the new basis. So in a run up to that, then there'll be old basis and new basis. So we can help you sort of just align how the divisional shifts have happened.
And we'll go to Harvey Robinson from Panmure Gordon.
I've got a question around margins. Clearly, you've had a great performance on gross margin in the year, 5 percentage points, £4 million, bigger great gross profit. Where do you think that gross margin might go to? Because it seems to me obviously driven by the software performance. You've got great detail on the breakdown at EBITDA level. And where do you think gross margins end up? And the sort of follow up to that, does that then mean that your EBITDA margin guidance midterm is fairly conservative?
I mean, when we look at it, I mean, we look at the sort of the cost of sales, the gross sort of profit, and the operating profit, looking at the sort of EBITDA level, Harvey. And I think, you know, we've guided over the medium term to 35%. Yes, we've ended up at 34% this year. I am cognizant of the fact that we are navigating our way through a sort of inflationary environment at the moment. You know, and therefore I'd hope that, you know, we'd come and beat the 35% over the medium term. But I think as we navigate our way through the next couple of years, I think it's just, I think it's sensible to, you know, we're in touching distance of that level, and we think that's achievable and sustainable. And so that's the kind of level we're holding it at the moment.
Thank you. That's clear. Thanks. Just a quick follow-up on acquisitions. You're talking about quite a lot of potential deals. Could you just give us a feel for what you think your firepower might be? Obviously, there's many levers you can pull, but is there anything particularly sizable in there, or is it just a whole potential range of opportunities? I know you've got to be careful what you can say, but it's quite to get a feel for. Is it a series of bolt-ons, or is it?
Yeah, I think no, that's it. That's fine, Harvey. I mean, I think we've in my conversations that I've had with holders and others, we've sort of guided to this year being one where we see ourselves doing more bolt-on acquisitions, bringing those things together. But it's fair to say that in our pipeline we have, you know, those things on a graduated basis. Really, you know, there are some larger deals in there that would prove very interesting if they became possible. But you know, I think this is a year where we're really guiding to people for us doing more bolt-on work. I think over the last few years we've shown we can do that really effectively. We integrate business as well, and we have a good model for doing that. So I think that will be our focus. But you know, there are other things out there that always, you know, have our attention. And as I say, should they become available, then they certainly have our attention. My take on it in terms of facilities, as Anoop said, we've got a 35 million RCF, we've got a 10 million accordion. We will come to renegotiate our banking facilities during the course of the first half of this year. We have spoken to our banks, and they're very supportive of our ambition and based on the performance of the business to date. So we feel very confident we can have facilities available to us to do more work. But for holders, we'd want to make sure that we were, you know, within reasonable bounds of debt. So probably to, you know, two times, if we can bring that and show that we'll bring that back down to 1.5 times in decent order as we bring acquisitions on and create the synergies that we think they could bring. So, you know, minded to that as we run forward. And but you know, some really strong opportunities out there. You can never quite predict how they're going to land, so we just have to take that as it comes. But good pipeline of opportunities, good facilities, and I think enough firepower for us at the moment to do the things that we'd like to do.
And we'll go to Kai Korschelt from Canaccord Genuity.
I just wanted to drill down into the expected growth acceleration to double digits, because that would obviously be quite an impressive achievement if you pulled it off in the current environment. And I'm particularly interested in sort of the thematic product or growth areas, you know, where you would see this growth acceleration. Is it, I'm really keen on sort of maybe 2 or 3. Is it sort of mainly Idox Cloud? Is it the geospatial stuff? If you could just give a bit more color on that, that would be great. And then the second one was follow up on the M&A environment. I think your main competitor on sort of an acquisitions has been Civica. They're obviously highly levered, private equity owned. So I'm just wondering if you know, if you are seeing perhaps less competition on the M&A front, and likewise perhaps a gradual easing of valuations, or are we not quite there yet? Thank you.
I mean, I think the growth is threefold, really. I mean, I think that there is an element of inflation built in. Clearly, you know, we have a contract structure where a number of our contracts, we typically have 2 sort of contract types or contract forms. One of those contract forms tends to be more fixed in nature, and therefore the opportunity to actually apply things like CPI and RPI are limited. There is a second contract form, so when contracts come up for re-signs and renewals, there is an ability to apply a level of inflationary uplift. So an element of the growth is coming from that. I would say probably about 1/3 of it. We have then the full year impact of the recurring revenue re-signs that we've had in 2021. And I would say that's about 1/3 of the impact. And clearly we're coming into a busy period now with a level of re-signs coming into the March and April period. So there's an element of win and do in there, which we've got good visibility of, and we're confident that we can get those over the line over the course of this year. So when you look at it, you look at the double digits and you go, okay, fine, it seems quite a jump, I suppose, from where the business has been over the last couple of years. But actually, we can see a route map or a roadmap to actually get there this year.
Yeah, I think that's fair. It's about a third, sort of, pricing, renewal and add-on, and then new business activity that goes through. And we feel good about that, and feel that the hard work we've put into the business in growing our ARR is a real strong foundation part for that growth going forward. So I think that's really encouraging. I think on the second part around M&A, we haven't yet seen people throw themselves on the mousetraps and think it'd be a great idea to accept lower valuations for their businesses. But I think there is a new realism that's coming out for everyone right now about valuations, and remembering that when we're doing the bolt-on acquisitions and we're classically in that sort of 3 to 5 million of revenue for these businesses, then I think, with COVID, with the geopolitical stuff we've seen, with a higher inflationary environment, and people faced with that, next investment decision, do they invest in their products, their people, their market capabilities? I think increasingly we're seeing people that are willing to listen to sensible offers for their business, and with an organization that would give their business a really good home for their people, but also some great market, go-to-market capabilities. So I don't think we're yet seeing the prices come off. We're classically in that 6 to 10 environment. That's where we feel valuations are right for that kind of business that can give us that sort of growth. And as we've seen with the Idox Cloud business, where we can provide the firepower in terms of sales and marketing, product development, and professional services support, we can accelerate the growth of those businesses by giving them access to or providing greater access to a larger customer cohort than they've previously been able to reach. So, I think we'll see that as we go through the year. I think inevitably prices will become a little bit more realistic, and that should help us get one or two of these things over the line during the course of 23.
And we'll go to James Lockyer at Peel Hunt.
Just one follow-on from an earlier question on the margin. So obviously the big step up this year in PSS to 36%. It'd be good to understand, where that's come from. Is it from the acquisitions? Is it from cost savings, operational gearing, as sort of part one? But secondly, your guidance around the 35% for the medium term appears that it's EIM that's holding you back potentially to getting there at this point. I saw a little tick up in the margin despite revenues declining there, so that's obviously positive as well. But I guess it'd be good to understand, to get to that 35, are we basically saying that PSS needs to become a bigger portion of the business? Are we seeing PSS maybe getting higher than the 36% margin? Or under the new structure that you're putting in place, the new business units, do you see possibility of EIM, growing its margin to help you get above that 35%? Thanks.
Yeah, I think when we first arrived, margins were, as you know, sort of 17, 19%. I think at that stage, Rob and I optimistically thought that if we could become a 30% margin business, that'd be great. That'd be in line with industry norms and away we go. I think as we developed the strategy and felt that we could become more of a software play rather than being a software and service play business, it became clearer to us that we should target ourselves at a greater margin percentage to reflect that position. I think as we run forward, I'm really clear that significant market positions help you to improve margins, and market share is the main driver of margins there on in, because obviously, the more you can do things once and repeat them many, helps you to improve margins without incurring the additional cost as you move forward, and our clients. As we attract new clients into the business, we're not really adding new amounts of cash to having to do client acquisition. So all of those things, coming together help us with margins. Some of it then is about operational improvement and continuing to simplify the way that we do things. And I think Rick Hazard's appointment across our development activity will also help us to accelerate standardization in some areas and give us the flexibility we need in others. But our aim has always been to be a rule of 40 business. We want to grow, we want to be able to grow the business in that kind of way. So it's certainly possible that as we go forward, we can improve on projected margins of 35. And as you rightly point out, James, acceleration of our growth in our public sector business would do that. But we also feel that, with the EIM business as we roll forward, there are better margins to be had across that portfolio of businesses, such that it isn't dragging back the margins in other areas of the business as we go forward. So internally, we'll have our own conversations and thoughts about what our margins ought to be, coupled with our growth. But I think if this year we could see our margins getting to around 35%, get to a 10% margin, a 10% growth organically within the business, plus some accretive M&A, then I think it offers obviously something well ahead of that rule of 40 business that we targeted when we first arrived. So I think it looks good on all fronts across those parts of the business. We just have to remain focused, disciplined, and get on with it.
And we have a few questions from Andy Darley from FinCap. He asks how much of the local authority opportunity you refer to is greenfield, where you can automate the formerly manual processes, and how much is displacing competitors? And a second question, what's the revenue uplift from cloud migration for formerly on-prem solutions? And he has a further question about the EBITDA margin. Having mentioned the rule of 40, he's asking, are you targeting a 35% EBITDA margin? Should we only expect single-digit growth in the near term, or are you stepping up to the rule of 50?
If we talk about the markets first and what we see as being greenfield or otherwise, I think it's fair to say that every local authority in the country has something in place that does what we do. So, the work that we do around land property and public protection, every local authority in the country will have a solution that deals with that in some shape, form or other. However, we firmly can see at Idox that our solutions provide our customers with the ability to do what they do more effectively and efficiently than other vendors in the market. And so we've seen our market share grow over the last 3 years as new clients have come on board and taken solutions from us that help them to do what they do better. So, we have between a 35% market share in our public protection area to around a 65-70% market share in our property space. And we see the ability still to do on-sell new name business in the remaining market percentages in each of those spaces. But importantly, we're also developing products and services that help customers become more effective in a number of areas that have not traditionally been associated with our core products. So things like engaging with the citizen, engaging the public in planning and public protection activity, providing those front of house services via products that help the council not have to interact with people, saving them money, allowing them to drive more capacity and capability in their own workforce. Those types of solutions for us are, there's some really strong opportunities for us to engage in those areas and to develop new market positions, which are additive to the things that we do today, and also which support the longevity of the solutions that we currently have in the market. So we think there's plenty of opportunity for us to go and do that. And then in terms of new greenfield sites, we're seeing this is where our geospatial activity comes in. as I mentioned earlier, our local authorities are only one part of a very expansive ecosystem that uses planning data across a wide spectrum. So, as you know, engaging with land and property management businesses, construction companies, conveyancers for property searches. There are a whole series of things that happen outside of the local authority that need connecting to the local authority in some way to make that whole supply chain work in a much smarter and better way. So we're definitely focused on those elements, and we see all of that for us at the moment as being a great white space opportunity running forward. So hence our interest in building out those businesses within our portfolio. In terms of margin, this whole thing of, can we become a rule of 50 business? Well, it is, I think we want to see progress before we were committing to such things. But I think it's clear that, if we can continue to see growth in the business and we can continue to see margin improvements, then, it's not beyond the wit of man for that to be the case. But right now, we want to get on, show that we can deliver the double-digit growth, continue to deliver solid margins around 35, and then look to expand and build out our market positions, the new opportunities we have. We think those things will be the enhancers to margins running forward. Anything you want to add?
Yeah, just on the revenue uplift from on-prem to cloud. I mean, clearly there is a opportunity to apply a premium as we support our customers through it. So I think I'd probably go as far as say, yeah, there is an opportunity to increase the levels of revenue there, but without giving individual cloud details.
And a final question from Ian Robertson from Progressive.
Two questions, if I may. The first one is on the R&D, obviously significant uplift. Could you give a bit more detail on the sort of things that's been spent on and how you might be able to leverage that across the wider group in the coming years, and how much you're going to be spending in the coming years? And then when we talk about this wider ecosystem, you've got all the technology in place as I could see it. Are you really going to just be out there looking for acquisitions to get market access, or are you going to be able to build yourself products and routes to market organically? And also in that area, what's on the other side? Is there anything that might be looking outside, looking at you and thinking, oh, actually, we'll go after the Idox space?
Do you want to do the first part? I'll do the second
Yeah,
part.
I mean, Ian, we spent 6.5 million in FY21, and actually a large chunk of that was the increase year on year. Really came, a lot of it came through from the acquisitions and the capitalization of the software development on those businesses. I think when I think about the breakdown of the 6.5, I mean, we're continuing to invest in the cloud solution that we've already talked about. We're continuing to invest in the LG offerings. Clearly, we have to move our product offerings in line with regulatory changes, particularly around, say, the elections database. We have to invest in that, have the software ready for those areas. So I find that actually when I look at the breakdowns of it, we are investing continually in each of the different product areas. So I think I will continue to do that going forward, because we're constantly having to respond to changes. Where do I see that going next year? I think it will tick up slightly from the 6.5, so probably closer to about 7. But having said that, when we look at the future income streams related to those items, we're comfortable that they will generate future revenue streams.
Yeah, thanks, Ian. I mean, really good questions. In terms of how do we see this new area around geospatial working for us, and the ecosystem that we're referring to? I mean, we know that for our business to be an attractive investment proposition rolling forward, we need to address some larger target, some larger TAMs, basically. We need some total addressable market that is increasing and improving. But by focusing on the things that we do incredibly well, we found more opportunity to sell to a wider cohort that is currently presented with good software solutions that automate the way that the processes currently work. Government for some time has been trying to surface data that helps to serve the market better, and yet at the same time the market is filled with more screen scrapers now trying to collect information than there ever has been. So the opportunity that presents itself from Idox is to bring together some of those business processes and automate them so that it works for the local authority and the people that need to access and gain access to planning data. But then secondly, to help local authorities surface data in a better way, in a more cohesive way, so that it can be used more effectively in this wider cohort. And we think by doing that, it's sort of almost, well, it more than doubles our target addressable market, which is very exciting, I think, for us as a business. And I think it should be exciting for shareholders. So as we move forward on that, we see, you asked whether we can see ourselves doing that organically or through acquisition. And the answer is a little bit of both. We've been keen to build a capability, which means over time we can build that share organically. And as I say, we have some fledgling things that we're working through at the moment that are quite exciting. And inevitably, as you get a little bit further into that, you can see other businesses that would act as significant capability bolt-ons to enable us to deliver those solutions in a smoother and better way for clients. So that's the thought for us. I think it's one of those abilities for us not just to add businesses that serve our existing cohort, but more importantly, provide us with capability, capacity to serve this larger ecosystem that we can see and help us to sustain bigger growth numbers as we go forward with our work over the next 3, 4, 5 years.
Okay, so and in doing any of that, there's nothing you haven't done before on a repeated basis with Idox.
There's certainly, it's an area that we're always familiar with. We understand the data, we understand the data flows, and we understand the environment. Inevitably, it always involves you doing something that you haven't quite done before. But the important thing there, it's related to the markets, our capabilities, and understanding. We're not getting into brand new areas. It's about how we put the solutions together rather than if. And the last part of your question was that other people out there sort of saying, well, let's have. That's always been the case. People are always everything we do day in day out is competed, sometimes with large competitors such as Civica that was mentioned earlier, or maybe an NEC software. At other times, it might be a smaller niche provider that you're competing with, but there's always competition. I think uniquely what Idox brings together is a level of substance and size and a capability to address these requirements today. And if you're a large London borough, a large metropolitan authority, then I think you want to be able to go to sleep at night knowing that all of these important functions in your business work and do so to best effect and reliably, and that you're supported by a business with some substance. So I think we fill that niche really well, and I think that comes through in our new business wins and the confidence that clients show to us in regard to new business. So always competition. We're never, we always carry the paranoia with us here at Idox. We're always concerned about those things, but we do so from a very positive point of view about developing our own offerings to the extent that it makes it easy for clients to make a decision to do business with us.
And that's the end of questions. David, do you have any closing remarks?
Look, I think Idox is produced a great set of results in what have been very challenging and difficult markets. We've been extremely reliable and clear about what our ambition for the business is, and we've delivered on that each and every time. And we have a tremendous amount of confidence in the business going forward, the market opportunities that we can see, and our own ability to execute against those opportunities. So looking forward to FY23, and we appreciate your continued interest in the business and your support. So look forward to seeing you all individually beforehand, but seeing you again at the back end of beginning of May or something, when we do the half-year announcements, and we can update you then on the progress in the business a bit more formally. But thank you for spending your time with us today.